Kia ora, I'm Chelsea Daniels, and this is The Front Page, a daily podcast presented by the New Zealand Herald. Inflation has risen even further. The latest Stats NZ figures show inflation reached 3% in the year to September. Economists had it tipped to hit the top end of the Reserve Bank's target band of between 1% and 3%. But some say the period of circa 3% could be short-lived. At the same time, Labour has broken its silence on what it thinks will help the economy. Today on The Front Page, NZ Herald business editor-at-large Liam Dann is with us to break down what all of this means for you and your wallet. So, Liam, the Consumers Price Index increased 3% in the 12 months to September. What has contributed to this increase?
Yeah, so, a few really basic things actually that will have made it feel like it's a lot worse than 3%. So power prices is the real headline, 11.3%, I think, for the annual rate. That was the highest annual increase we've had in New Zealand since 1989,
Wow.
So 36 years. So that people really felt that. I mean, bear in mind that we've been through this. This is stuff that we've already had the headlines of people complaining about the power prices, and we're just now counting the costs. But we had rates up 8.8% across the board, roughly, and they tend to get counted once a year in the September quarter, so that's when we see them contribute. They actually were up 12% the year earlier, but that's still a lot. It's still a high increase. And food prices, I think, were up 4.6% for the year, so that's still ahead of the 3%. People obviously have been feeling that with dairy prices, butter, beef, some of those things that are getting good export dollars for New Zealand, but are making it painful for shoppers and for consumers in the short term. So when you look at those three things, they're sort of unavoidable basics for a lot of people, especially the power and the food. And that is a problem. But also it's sort of seen by the Reserve Bank as sort of a shorter term thing. So I think that 3% number has landed where it was largely expected to be and shouldn't cause too much problem for the Reserve Bank for those looking to hopefully see another interest rate cut.
Yeah, I mean, I saw economists were kind of across the board saying it was going to reach that top end of the higher bracket that the Reserve Bank wants to kind of keep it into.
Yeah.
Are you surprised that it's not over 3%, to be honest?
Yeah, it could have been. I mean, the other thing is, those power prices, we had a high wholesale price. There was weather conditions, but we also had a thing that comes through. They do a sort of a regulated price increase based on power distribution costs, and that comes through every 5 years. So that's another one-off in there. So there's a reasonable, there's a bit of an increase in tradable inflation, what they call tradable inflation, which is those things that we don't have much control over in the economy, food and power and stuff. But non-tradable, which is in the core of the economy, services, wages, what we're paying each other, that is coming down. I mean, it's always a little bit higher anyway, but it is coming down quite sharply because the economy's been in such bad shape. So I think economists could see that the things that push prices down, recessionary forces that push prices down, are sort of happening. So I would say they're fairly confident that this will be the peak of this cycle of inflation.
In terms of how much our inflation is imported versus domestically generated, what would you say to that?
Well, that is that split, non-tradable and tradable. So non-tradable inflation tends to run a bit higher, but that is coming off. Tradable inflation, the imported inflation, we'd had a pretty good year last year on that, and that's come back with the food prices and things. And so I think, but that some of that tradable inflation, I know we've got to be careful because we tried to look through it after COVID, and it all exploded with inflation keeping on going and going. But generally, the Reserve Bank does look through that a bit more, because those are those international prices that are volatile. Petrol's an obvious one, but food commodity prices and some of those other imports and things, they go up and down a lot, and it would include power prices. And that means that the Reserve Bank can ignore those to some extent, and it focuses on something called core inflation, which is a measure of inflation with the extremes cut off, and looking at how it's tracking over the long term or medium to long term, and they'll be more comfortable with that.
Right, so the Reserve Bank doesn't seem too spooked over this. Should we see another OCR cut next month?
Yeah, I think we should. I think we probably will.
Yeah.
Whether that's it, and if the economy continues to sort of struggle to get going and the recovery hasn't taken off, some economists see some risk of another cut maybe in February, or that the Reserve Bank might do 50 basis points in November. But I don't know. I think there are some signs that it's things are starting to turn. A lot of the bad news is in the rear vision mirror. It's just the way we collect data, so we're seeing it at the tail end. Unemployment will rise probably in the next lot of stats, and it will be ugly as well. So, it's a line call, but the Reserve Bank's primary job now, single mandate, is to look at inflation. So I think probably one more cut and done, and they should probably signal to New Zealanders that they feel they're done, because that will encourage New Zealanders to lock in their interest rates and actually take some of the savings, and we can all move forward a bit.
Well, inflation is at 3%. It's within the band of the Reserve Bank. Under Labor, it was at 7.3%. So we have brought inflation down in just under 18 months, or 18 months, 2 years, and that's making a big difference. If you care about working people and who are doing it really tough, you actually manage an economy well, and you make sure you get spending under control, so you get inflation under control, so you get interest rates down. That's exactly the path that we've been putting in place. So, they wrecked the economy. Let's be clear. They just spent more, taxed more, borrowed more, and they'll continue to do more of that going forward. But that is what caused the pain and suffering that New Zealanders are experiencing up and down this country.
When everyday New Zealanders hear that inflation is at the top of the target range, what does that actually mean for them day to day?
Well, it's all about those basics, the food and power. Rents. I mean, rents was actually quite promising. Rents had dropped to 2.6% annual increase, and if you look at it, what's happening month on month, it's really almost flat to zero. There are parts of the country where rents will be coming down. So that's moving with the property market and with mortgage rates coming down and house prices being subdued. But yeah, I think the trouble is for New Zealanders who spend most of their income to live, they feel inflation a lot more acutely. So if you've got a lot of money and you're got a lot of discretion around most of your spending, and your core living expenses are only 30, 40, 50% of your total income, then it doesn't matter if it goes up 3% or 5%. You've still got all this discretion at the top end. But if you're spending all your money on living, and particularly if those basics have gone up by more than 3%, you feel it completely. You feel all the inflation, and so it hurts poorer people harder. And look, I think New Zealanders more or less didn't really get over the inflation shock post-COVID. We moved pretty quickly into a period of higher dairy prices and meat prices and things. And so, when you hear New Zealanders talking about it, a lot of people still feel like we've just had this one long cost of living crisis.
Do you think the Reserve Bank's current approach strikes the right balance between controlling inflation but then also supporting growth?
I think so. I mean, there's an argument that they've been a bit slow to get interest rates down. The difficulty is they do have a single mandate. They've got a single target. The government changed that. They used to have a target that have a mandate that said you should weigh up unemployment and inflation and consider those things. I mean, all central banks will consider the big picture, but then if your number one job is inflation, you can't take the risk that it goes above 3% and becomes embedded and gets hard, is hard to get down. And I think central banks around the world are feeling a little bit shell-shocked after the inflation that we had post-COVID, when it got up to 7-9% and all that stuff, and it got away on us. And they do not want to have to go through that kind of cycle again, where we're having to sort of do things to get on top of inflation. So they just had to be a bit cautious, unfortunately, and they couldn't just sort of slash and burn. But it's looking, I think, despite this number, in some ways it's looking a bit safer for them.
You're always so optimistic, though. You always try and stay optimistic. I mean, realistically, is 2026 going to be better, or are we still riding the wave up until the end of 2026, and then entering 2027?
Well, it's gets a bit painful, actually, because I try to be optimistic, but it's just taking so long.
Even the straw's going to break your back soon.
And, you'll see my columns will swing between pessimism and optimism, but I think the conditions are all in place. Interest rates are low enough now to start stimulating the economy. There is all that export money coming in from the dairy industry, the meat industry, kiwi fruit, even tourism is starting to pick up a bit. It's sort of almost back at pre-COVID levels, which was a pretty good earner for the country. So those things really ought to shift the economy. There's a big deficit in confidence. People businesses are wary of investing. People are shell-shocked. I think, unfortunately, the lagging statistics are things like the jobs, labour market, liquidations. You're going to still see negative headlines. You're going to see more liquidations of businesses, unfortunately. You're going to see more layoffs and rising unemployment. And that will sort of keep a dampener on things probably into 2026, just because we won't get statistics, through for if unemployment peaks early next year, we won't see those statistics till the middle of next year. And I think that's really what's, the cost of living is one stress, and then the other one is people not being secure in their jobs. And so people need to be secure in their jobs to start spending, because the money coming back through lower mortgage rates is going into savings and paying down mortgage, while people are worried that their earnings might not be around where they want them. So it's a slow thing to get the momentum rolling and get the confidence back. But I think it will happen.
As a parent with 2 young kids, I worry a lot about what kind of future they are going to inherit from us. Unemployment's going up, inflation is going back up again. More and more New Zealanders are simply giving up and leaving the country, while our economy shrinks, businesses close, and opportunities seem to be disappearing. We need to turn that around. We need to create a future that young New Zealanders will want to be part of. A reason for our young New Zealanders to come home after their OE. A reason for them to stay here in New Zealand, because they know they can get good, well-paid jobs that will create the sort of opportunities that they deserve.
Right, so the Labour Party has announced this New Zealand Future Fund, which it is calling its plan to back New Zealand's potential and create secure, well-paid jobs across the country. It'll do that by investing in New Zealand infrastructure and businesses, lift productivity, and reinvest by seeding capital from a number of Crown assets, independent governance of that, and protecting core assets from privatisation. Not a small task, I would say.
No, I mean it's a big concept. It's a concept that's not new in a way. I mean it's interesting. This is their first bit of economic policy that they put out, and it's how I describe this. This is going to be administered by the New Zealand Super Fund, which has got billions of dollars, and invests wisely and sensibly around the world and in New Zealand, but doesn't want to go crazy in New Zealand because it has to have a balanced portfolio and keep making money. But I think that Labour's pitching this. These are my words, as a kind of a side hustle for the Super Fund, so that the Super Fund would have a sort of like if you think of a big money manager, a big fund, having a boutique fund off to the side that is very specifically for New Zealand businesses, that's smart, innovation, probably tech, but it doesn't specify that exactly. It could be for infrastructure, and so much more of a New Zealand Inc. kind of focus. And you sort of spin that off to the side. You have it managed by the super fund. They look at countries like Singapore do it, and they've been very successful and have, billions of dollars worth of assets. So it's possible that what the goal is that you actually make money because you're investing in these companies and taking a stake, as well as providing capital and support for them to get going and boost the New Zealand economy. The critics will say, and there'll be a hard criticism from, say, the ACT Party, and because they see that as governments picking winners, and they look at the failures over time of governments doing that, and sometimes governments get it wrong. Why is the government trying to pick one company over another and decide which one? Well, it won't be the politicians, it'll be a board of investors as part of a state fund. But they're sort of ideologically opposed to that. It would sit quite well with the way New Zealand First looks at the world in terms of a state-controlled investment, a sort of a mixed model. It's capitalism, but it's with a state involvement in capitalism.
Well, I was going to say the vibe really does give New Zealand First, not the party, but putting New Zealand first, which I think Winston would quite like.
Yeah, I mean, I think that'd work. I mean, in fact, even National could probably cope with this kind of policy if it didn't have to have ACT as a side partner, because you hear Christopher Luxon talk about countries like Singapore and Ireland, all these countries that have accelerated their growth with investment and innovation. And Singapore is a classic example of one where they really they save money and they put money back into their own economy and their own tech companies and startups. And dare I say it, it's kind of a it's not communist Chinese, but it's modern China does it very intensely as well. Modern Chinese economy is very focused on picking winners, special zones where they build industry up and they put government money into it, and it's a kind of a sort of mixed model capitalism with the state involved. I mean, this isn't a sort of a revolutionise the whole economy. It's a very specific fund. I guess it's something that could work, and you leverage off the super fund, which has got this infrastructure for investment. So you keep it very market focused and keep the disciplines there to make sure that you're not just throwing money at things, you're actually investing in things that will deliver a return. It's a higher risk area of investment. Once you get in, the closer you get to seed funding, it's like venture capital, and you're investing in companies at a very early stage, so there's a higher rate of failure. But when one takes off and really does well, like literally takes off like a rocket lab, or
I was going to say that.
It can go on to be worth billions. So the private investors that do that tend to have a large portfolio. You need to sort of maybe invest in 50 things, and if one or two of them take off, you'll actually make your money back because you've structured things in a very clever way. And that's what this would need to do. It would need to be very focused on sort of market disciplines and have a really good investment team, and it's a good idea. I mean, I think that's something that
well, it's something that we've looked to Australia. Australia uses their super fund in much more diverse ways than we do, right? And it's something that economists have been toying with for years.
I mean, Labour's mentioned the Aussie version and how they do it, and they've talked also about pushing the New Zealand super fund to do a bit more infrastructure and some of those things, and it does do a decent chunk, but its primary job is to earn money for our retirement savings. So it has to stay a bit more balanced. And this is probably a way to sort of silo out this more sort of, New Zealand-focused, innovative end.
Baby steps.
Yeah. So, I mean, promising. I mean, as I say, it's something that could be a bipartisan thing. ACT would hate it, so I can't imagine National getting on board with it. But I could imagine somewhere down the line, if a Labor government introduced this, it wouldn't be removed, put it that way.
Well, Hipkins has said that Luxon, and I quote, has no plan for our economy and that he is relying on house prices, the Reserve Bank and foreign investors to turn everything around. What do you make of that statement?
Well, that's sort of a plan. The foreign investment thing is part of the plan. They are trying to. So I think, to be fair to Luxon, there is. He would argue that there's very much a plan. They want to get the New Zealand economy into good shape by dealing with some of the fiscal issues, making it a safe, stable place to invest, and then get out and attract foreign investment. So they believe that foreign investment can really do a lot of the job that I guess Labour's talking about with this. That is a way to do it. That's the way Ireland's done it. So you probably could just about go, well, there's a Singapore model and there's an Irish model. This government hasn't got the money to quite do a full Irish model because it involves cutting taxes for foreign investors. But it's definitely trying to make it New Zealand more attractive for foreign investment. I think it's a bit unfair to say they're just relying on house prices, because you listen to Chris Bishop, he's sticking to his guns that the flat to falling house prices are a good thing. Look, the reality is house prices come back. It probably helps the economy and helps the government, but I don't think they're pushing that too hard. I mean, they've been prepared to wear a fairly big downturn. Look, is there enough of a plan? Well, that's highly debatable, but I think some of that was rhetoric from Chris Hipkins.
Thanks for joining us, Liam.
Cheers.
That's it for this episode of The Front Page. You can read more about today's stories and extensive news coverage at nzherald.co.nz. The Front Page is produced by Jane Yee and Richard Martin, who is also our editor. I'm Chelsea Daniels. Subscribe to The Front Page on iHeartRadio or wherever you get your podcasts, and tune in tomorrow for another look behind the headlines.